we've seen gold be able to appreciate between 50 to 100%. Now, I'm not saying gold prices are going to go to 4,000, but over this sort of 2-year period with all of these factors coming into play, I think we can definitely see gold go to 2,400 this year to the dollar, and possibly to 3,000 in this entire gold cycle over time. So what that means to a gold investor is to continue to average in. Don't try to pick the moment, because all these factors don't happen at the same time that gold is going to spike, but continue to accumulate on a regular basis, because I believe we are in a gold bull cycle for all of these reasons.
After the FOMC's January 2024 meeting, their statement clarified that additional rate hikes were off the table, barring a dramatic change in the economy's current direction. Based on the Fed's indications in late 2023, markets began to price in a series of Fed fund rate cuts for 2024, with many anticipating that such cuts would begin as soon as March. However, after January's FOMC meeting, the timing of a start date for rate cuts seems less certain. Many investors anticipate rate cuts when they eventually happen, and if quantitative easing, QE, is implemented before that, markets may see it as a positive step. When it comes to commodities, especially gold, Nomi Prins, geo-macro economist and best-selling author, points out that the response tends to be more attuned to quantitative easing rather than just interest rate cuts alone. Despite uncertainty surrounding the timing and extent of rate cuts, UBS maintains its expectations for the Federal Reserve to ease policy. Nomi addresses the potential impact of economic policies, such as interest rate reductions and QE, on gold prices. These measures, intended to stimulate economic growth, often drive increased demand for gold as a safe haven asset, potentially surpassing prices beyond the $3,000 level. Johnny Tevis, the investment bank's precious metals strategist, expects gold to hit $2,200 per ounce by the end of the year, anticipating it to be propelled higher by a Fed easing and a weaker dollar. Central bank actions remain pivotal in shaping gold market dynamics. Central bank buying maintained a rapid pace, with annual net purchases totaling 1,037 tons last year, just 45 tons shy of the record set in 2022, according to the WGC. China continues to lead global demand for gold jewelry and secured the top spot in worldwide central bank gold purchases last year. As the leading player, the People's Bank of China has significantly increased China's gold reserves, surpassing a milestone of over 2,000 tons. Stay tuned for clips from Nomi Prins's interview with Kitco News. And if you want more videos like this, please hit the subscribe button and turn on the notification bell for updates. Thank you, and enjoy the video.
I think the commodities market understands QE a little bit better, and the gold market than the equity market if it's detached from rate cuts. I mean, we had so much and have so much attention on rate hikes or the possibility or the timing of rate cuts over the last couple of years in all of the sort of media, that's kind of where a lot of the markets focus first on those interest rate adjustments. And so yesterday, when there wasn't an interest rate surprise to the cutting side, because I think it's a surprise. There was no indication to me last December that there was going to be a rate cut in March. I think the markets wanted it, didn't get it, but I don't actually think it was telegraphed. So that's one thing. And I think they're going to regroup and be fine, because they're going to look past the March meeting to the summer now. And there's going to be volatility out there. There generally is before and around these FOMC meeting announcements. But I think overall, there is a lot of money on the sides. There is knowledge that there will be rate cuts when they come. And if we do see QE before that, I think the markets will look to translate that as just a step along the way. And that's positive for things like tech and sort of more of the types of sectors that require cheaper money, or at least are looking towards cheaper money. On the commodity side, on the gold side, I think it's more in tune with quantitative easing. If we do look at sort of where the Fed has been on quantitative easing versus where gold prices have reacted, they tend to react more positively to quantitative easing net of interest rate cuts, and then obviously more so to those, because those decrease the value of the dollar, and that increases the relative value of gold to the dollar. So it really depends on which part of the market we are looking at. I do, and I think gold investors, as you say, as we've discussed a lot, tend to be savvy about timing. In other words, not trying to time when gold is going to specifically rise by a certain amount in a certain, tiny fraction of time, but to look at all of the factors that we see coming together right now for giving gold prices a lift, and those include what we've been talking about, the ultimate reduction of rates, and potential QE along the way, and potential bank crises along the way, which we have seen historically to be net positive for gold. Any of those have added between 10 to 20% in and of themselves to the price of gold around the time that they happen. We also have continued central bank buying, particularly led by China, as the desire for more geopolitical independence continues to filter through the BRICS countries. And now the BRICS countries include a number of other major oil producing countries like Saudi Arabia, who are also looking towards buying mines for gold and other commodities. So we see this trend towards finding and utilizing more gold in moving away from trading specifically with the dollar, at least diminishing that trading amongst those countries, and also just in general, sort of moving away from the strength, the supremacy of dollar-related policy and U.S. policy. So that's going to continue, and that we've seen add between 10 and 20% to gold prices over time. And also we have an election year. And what we've seen, and it's sort of been in tandem with banking crises since 2008, is that gold tends to rise and the dollar tends to fall in the year or two after a major election. And given that's the case, and in the last, since 2008, actually even before that, going back to 2000, we've seen gold be able to appreciate between 50 to 100%. Now, I'm not saying gold prices are going to go to 4,000, but over this sort of 2-year period with all of these factors coming into play, I think we can definitely see gold go to 2,400 this year to the dollar, and possibly to 3,000 in this entire gold cycle over time. So what that means to a gold investor is to continue to average in. Don't try to pick the moment, because all these factors don't all happen at the same time that gold is going to spike, but continue to accumulate on a regular basis, because I believe we are in a gold bull cycle for all of these reasons.
According to a Federal Reserve survey, U.S. banks anticipate an increase in demand for loans as interest rates fall this year, even as they further tighten credit standards on some types of loans. Recently, a report on the Social Science Research Network found that 186 banks in the United States are at risk of failure or collapse due to rising interest rates and a high proportion of uninsured deposits. The report, titled Monetary Tightening and U.S. Bank Fragility in 2023, Mark-to-Market Losses and Uninsured Depositor Runs, estimated the market value loss of individual banks' assets during the Federal Reserve's rate-increasing campaign. But renowned analyst Nomi is quite positive about the banking sectors, acknowledging the possibility of a banking crisis, but not foreseeing a massive market crash. She believes there will likely be some form of quantitative tightening, QT, or at least a backing off from QT. Eventually, we may see rate cuts later in the year, making money cheaper and benefiting sectors like technology and commodities. Any banking crisis would likely be managed through quantitative easing, providing market liquidity and stability. Let's get back to the interview.
Well, I think ultimately the equity market ends on a positive note, because ultimately over this year, we are going to see some form of QT, or at least backing off a QT. We are going to see rate cuts at some point later this year. So there will be a cheapening of the cost of money that will come into the markets that is good for, particular technology sectors and the commodity sector. So this is going to happen just over time. What that means is, though, there's going to be a lot of volatility. Markets and market commentators tend to be very impatient about every single reaction to every single number that comes up, particularly, with the FOMC meeting announcement. So I think we're going to continue to see this sort of volatility surrounding the next few FOMC announcements. And what that ultimately means, for example, with respect to technology and those sectors that require more cheaper funding for their growth strategies and their development, that includes AI and, the entire tech sector, is that, the best strategy for dealing with all of this is to be patient. And what does that mean? It just means legging into positions in overall tech names. If you have $1,000 to invest, it's 250 at a quarter. If you have, and more in terms of what those investments could be, retail versus obviously institutional, the numbers go up. But basically, to divide out the outlook over time and sort of average into the upside as opposed to trying to time it this year. So no, I don't see an overall market crash. I do see the potential for a bank crisis and crashes or bankruptcies or failures continuing in that sector. So it is, just to be clear, a sectoral kind of look that I have as well. There will be contagion to the market, but again, that will be remedied, I think, by these open doors now to whatever type of QE tools can be utilized for that. And the market cares ultimately less nowadays about specific regional banks failing. Look, it's different if we have JP Morgan failing. I don't see that happening. But we've been able to sort of gloss over the sort of regional banks failing, including not even talking about Citizens, barely in the news last year, towards the end of the year, because it just didn't sort of rate. But it was a pretty major regional bank that failed. I think the markets can digest that with Fed help to the banking sector or the regional banks that remain standing. So they're kind of springboards for market going down, market going up, and that's why I mean. What I say before about looking at these investments this year as very much cumulative rather than trying to pick a point, because we will see this sort of volatility come in from a sector perspective and potential banking sector.
According to FXS, gold prices are expected to rise as the Federal Reserve is anticipated to cut rates in May, dispelling hopes for an earlier cut in March. Central bank and Asian physical buying could lead to a rebound, with projections of gold hitting $2,200 in the next quarter. What's your take on how Federal Reserve policies, like interest rates and quantitative easing, affect gold prices? Share your thoughts in the comment section below. If you find this video informative, remember to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.